Hi, everybody. This is Pete Swisher with Pentegra Retirement Services, and we're here to talk today about some developments in the world of retirement plans around multiple employer plans. There was an executive order that was published on Friday. We're going to talk a little bit about that, about what it means for the U.S. retirement system. I am happy to have with me today the General Counsel for Pentegra, Robert Allen. I'll introduce Robert in a little more detail in a second, and also Michael Krebs, who's a principal with the Groom Law Group, and I will introduce him in more detail later on in the presentation. But we're going to jump right in. I know folks will be joining. We are recording this presentation, but I appreciate everyone being here right at the top of the hour, and we're going to launch. So, first of all, what's going on? If you haven't heard yet, there was a press conference on Friday afternoon in Charlotte, North Carolina. The president was there with a number of folks from Congress and some local people, and also the heads of some associations. So you had the Charlotte Chamber of Commerce represented, you had an international franchising organization that was represented, you had a home builders association that was represented. So the association presence was not accidental. The order was basically the president saying to the regulators, to the DOL and the IRS, expand access to multiple employer plans. So the essence of this letter was multiple employer plans are a good idea, especially what they call association retirement plans, although they equated association retirement plans with multiple employer plans, or MEPs. But the idea is let's open the access, and there's some history here. And so I'm going to turn to Robert Allen, but as I'm doing that, I'll tell you a little story about my experience with Robert. I remember coming to Pentegra about 6 years ago. Robert's the chief counsel. Pentegra's been around 75 years, and Robert, I know you've only been here maybe 73 of them or something like that. He is our chief counsel and carries a weight of knowledge. So I'm asking him this question about serving as the administrator of a retirement plan, something that other firms, typically not comfortable doing. And I'm seeking to understand this. And I asked the question, is there any reason to fear, serving in that capacity? And his answer was instinctively, well, it's what we've always done, which isn't the normal sort of answer you get from corporate counsel. But I think the reason for that sort of response, the way that he thinks, the way that you have to look at things when you're in a multiple employer plan, is that somebody's got to be in charge of the thing. So I thought it would be pertinent if we started with a little history to just set the stage. Why are we here? What's going on? And so, Robert, maybe give us a little bit of background about your history with Pentegra and about Pentegra.
Okay. Thank you, Pete. Just one little correction. I've only been with Pentegra for 32 years, but it feels like 73 years. So
I was off a little.
No, it's still off a little bit. But I appreciate your introduction, because really the purpose of giving a history of Pentegra with MEPs is not so much for Pentegra, but how do we get to where we are today, and why are we all here to talk about President Trump's executive order. So essentially, Pentegra does have a 75-year history with MEPs. In 1943, a very large defined benefit plan, MEP, was formed by the Federal Home Loan Bank System for their employees. And in 1970, a companion program was formed, which is the same structure, but a defined contribution plan, again, for federal home loan banks and financial institutions. I want to talk a little bit about the structure of those programs, because they're what we currently think of as what I call closed MEPs, clearly satisfy the DOL requirements for what constitutes a MEP. So in essence, those two large plans that I said started in 1943, basically they have a fiduciary board of directors. The board is the principal named fiduciary, and the president is the ERISA named plan administrator. So within that structure, they're essentially providing fiduciary protections and safeguards. And basically, it's a classic MEP in the sense that it provides all the economies of scale that people would want out of a MEP. There's a single Form 5500 filing, there's a single plan audit, there's a single ERISA bond. So it really includes basically the best, I feel, protection from a fiduciary standpoint and economies of scale that you can get from the standpoint of a retirement plan. But why is it a closed MEP? Why do I say that we're not at all concerned about satisfying the DOL requirements? Because the DOL requirements historically, and they're really still in place today, They indicate that unrelated employers can participate in the MEP only if they share a nexus of commonality of interest unrelated to the retirement plan. If you look at the statute, essentially only a bona fide group of employers can establish a MEP, and that requires two prongs of a test to be satisfied. Essentially, the first prong has to be there's a nexus among participating employers, and different factors are considered in determining whether there's a nexus. Is there an industry connection? Is there a pre-existing relationship among the participating employers? So as I mentioned, in those two programs, they were formed by the Federal Home Loan Banks. There's a commonality of interest there. The second prong of the DOL's requirements for a true MEP treatment is the participating employers must have control over the plan. And I said it rather quickly, but the board of directors are all members of the plan. They have their own benefits at stake, and it's through those boards by which the participating employers have control over the multiple employer plan. So we've been very comfortable with that structure and satisfying all of the DOL requirements and enabling us to provide those economies of scale in a single 5500, single plan audit, single fidelity bond, etc. We often thought that it would be great if we could open up those programs to what I'll call maybe unrelated employers, non-financial institutions.
Hey, Robert.
Yes.
Well, I want to highlight something. So before we go on a little bit, so first of all, folks, this is not a Pentegra commercial. We do have a point here. So we're setting the stage for what the executive order we think is about and where it's likely to head. And this issue of nexus control, these are critical elements, and also the issue of who's in charge of the thing, who's allowed to be a fiduciary, and what's their responsibility, and what's their liability. These are central issues as we are going to draw out. We thought this would be a helpful example. So, Robert, I think you were about to say, wouldn't it be cool if you could open up a closed MEP?
Right, and I'm not saying that for our purposes. I'm saying that really for employers' purposes and really the benefits of employees throughout the United States who don't have employment benefits, retirement benefits. So in the side conversations that we had, the Gloom law firm, of which Michael Krebs is a member, formed a group of legal people, and we participated in that group starting, I believe, in 2010 or 2011, really with a view towards a goal of trying to get the DOL to essentially broaden who could participate in MEPs. And we worked with the DOL. We even met with the various highest level of DOL officials, and basically trying to get what I might call an open MEP to get closed MEP treatment. And I'll get to that in a little bit. But the bottom line is we were not successful in our goal at that time. The DOL issued an advisory opinion. It was 2012-04, capital A, which again, many of you may be familiar with, but it essentially held that employers that participate in what we call open MEPs, which they're not related, they don't have the commonality and the nexus that we talked about, basically they would be deemed to have their own individual plans under ERISA. What does that mean? That means that they would have to file their own Form 5500. They'd have to have a plan audit if they were of the large enough size. They'd each have to have their own fidelity bond. So they would lose some of the arguable benefits of participating in a closed MEP. And the DOL spoke firmly on that matter. Well, what did that mean? That kind of put a damper on MEP participation at the time. In particular, if you had MEPs that weren't sure of whether there was industry nexus, member control, whether they satisfied all the DOL requirements, there was a large fear that the DOL could come in and basically have retroactive penalties for not complying with all of the requirements. So there was a lot of fear put into place. Now, our position was that we heard the DOL's words, and we took them very seriously. We still felt that you could have what I call an open MEP, a program where basically you have a single plan document, and it would still provide a lot of economies of scale because essentially under Internal Revenue Code Section 413C, basically a MEP is a plan that's adopted by more than one participating employer. So we felt that we could satisfy the Internal Revenue Code requirements by having a single plan document, a lot of economies of scale, but we had to heed the DOL's ruling And what we said was under ERISA, for these so-called open MEPs, we would basically view them as separate plans, meaning that we would file separate 5500s for each participating employer. If they were large enough, we'd do separate plan audits, and sometimes actually that worked to the advantage of employers if they were all small because they didn't require any audit, and there'd be separate fidelity bonds. So from the standpoint of an alternative, we have felt comfortable with that type of arrangement and continue to feel so. We had published a paper in 2012 in terms of putting forth our stance, and we still continue to believe in that stance. But the bottom line is the DOL did not permit the treatment of open MEPs as closed MEPs. So we still feel that that is a very viable alternative, but it didn't go all the way. So that's kind of where we are getting to today, and why are we all here talking. Basically, last Friday, as you know, President Trump signed an executive order, and it directed the DOL and the Treasury Department to basically consider issuing guidance, and I use that word strongly, consider issuing guidance or regulations that would have the effect of easing obstacles employers face in offering retirement benefit programs and increasing employee access to retirement benefit programs. So basically trying to enhance retirement security. And the executive order focused on three areas. The first was expanding the availability of association retirement plans, which, as Pete mentioned, are also known as multiple employer plans, and that's really the focus of this webinar. There are a couple of other areas that the President asked for, basically easing the required minimum distribution rules that apply to individuals over age 70 and a half by means of reviewing and updating mortality tables, which are used to calculate retirement minimum distributions. So there's a concern of, with increased mortality, will people have enough money to last a lifetime? And the third area was improving notice requirements to reduce the paperwork and administrative burdens for plan sponsors. So an example of that would be considering modernizing electronic delivery rules. But again, the focus of this webinar is expanding access to MEPs. Now, one of the things that many of you may realize is there have been a number of bipartisan legislative proposals to expand access to MEPs, but this executive order does not comment on any of them. So before going on, I just wanted to mention it's important to note what is an executive order. What does this really mean, if anything? Basically, an executive order is a directive issued by the President of the United States that manages the operations of the federal government and has the force of law. And where do you get this authority? It's really through Article 2 of the United States Constitution. It gives the President broad executive and enforcement authority to use his or her discretion to determine how to enforce the law or to otherwise manage the resources and staff of the executive branch. Well, the executive branch includes the DOL, the IRS, and the SEC, who all have an impact in the retirement benefits area. It's important to note that an executive order is subject to judicial review. It can be overturned if it lacks support by statute or the Constitution. And again, to keep in mind that any policy initiatives require approval by Congress, but executive orders can have significant influences over the internal affairs of the government. Now, the executive order that was signed by President Trump did not make any changes itself in the area of MEPs. What it did do was it required the DOL to decide within 180 days whether or not to issue guidance or regulations. So consequently, there's no guarantee that anything will be done, but I would look to Pete and Michael. My view is I would expect the DOL at a minimum to issue some type of guidance. So that is really where we are today and how we've gotten to this point. So
thank you, Robert.
Michael.
So I'm going to let me draw out a couple points. We had and in fact, I'm going to go back a couple slides here. So I think one of the points to be made when we talk about the Department of Labor Advisory Opinion 2012-04A, I mean, that really is the pivotal guidance that has set the stage for where we are with MEPs today. And it served as a dividing line that was maybe didn't have to be, the industry maybe didn't have to have the response that they did of just completely pushing away from every form of MEP. Really, there was just a lot of confusion, and there was a lot of misunderstanding about what the benefits are and there was this belief that, the DOL had made it illegal. There's another variation of this. I was talking to somebody at one of our partner firms, and someone came into his office and said, "Did you hear? They just signed open MEPs into law." Nah, that's not what happened. That's not what actually went on here. So that there was a movement then to search for an alternative. There was this belief that the wet blanket had been thrown on the party. There was nothing you could do, and that it was a really big deal to have to do a 5,500 for every adopting employer. 5,500 is not a big deal. It really is not. Having a single audit, that's a really big deal if you have an audit, but having to have an audit is not a good deal for a small employer who wants nothing to do with an audit. You don't want a phone call from an auditor. You don't want the expense of an audit. So there are actually some pros and cons to these different structures, and the industry kind of had to work their way through it. So I think that's one point, is there was a response. And the other is, one of the precipitating events for this particular piece of guidance was a month before 2012-04A came out. The Department of Labor weighed in on a case against a MEP fiduciary, Matthew Hutchinson. And Hutchinson was in charge of a multiple employer plan, was kind of an early pioneer in the multiple employer movement, and ended up getting convicted on 17 or multiple counts of fraud or malfeasance, and 17 and a half years sentenced to prison term. So it was an enormously significant event, and it very much shaped the thinking of the Department of Labor, and it has also shaped the thinking of other people in Washington. So we're gonna turn to that issue in a little bit with Michael. But let me just talk briefly about the response then. So here's the industry thinking, oh, open MEPs are so cool, everybody's going to start one. That's why we call it the gold rush. And there were some pretty wacky structures that were being proposed back in the 2010, 2011, 2012 timeframe at the time of this thing. And that all kind of came to a stop. And then you started to see terms like exchange, or an aggregation program, or a multiple employer aggregation plan, and these are in quotes because these are not terms of law, of course. These were marketing terms that were useful to describe what people were attempting to do, which is pull together services to mimic a multiple employer plan. You also have the term group trust. Group trusts are beyond the scope of this today, but I will simplistically say, Pentegra has history with group trusts as well. We have a couple large ones that we serve in a couple capacities. They do not enjoy all the advantages of a multiple employer plan, but they have advantages. They're significant. They're useful programs, as are these programs that go by the names like MEP and aggregation and exchange programs. These are all useful programs in one way or another. So one of the questions would be, how are these programs affected by anything that the DOL and IRS might do as a result of the executive order? We'll come back to that. All right, let's shift gears a little bit. Michael Krebs is a partner at Groom Law Group, as we've introduced. Michael and I actually go back a ways. And Michael is probably almost 10 years ago, but I remember I was starting off in kind of volunteering within our trade groups. The American Retirement Association launched in 2011 the National Association of Plan Advisors. I was part of the early effort to launch that, and I was the founding chair of the Government Affairs Committee. So as part of that early effort, this was probably in late 2010, 2011, there was a meeting in Washington, D.C., where all of the folks who were involved in this effort were in a room, and sitting at the head of at this big table is Michael Krebs. And I'm looking at him, and he's younger than I am, and I'm thinking, here's this young, smart lawyer. He's talking about this stuff. And one of the things he was introducing was, Michael, I think it was the Harkin thing, which you can talk about a little bit. But
yeah.
Anyway, I asked a question, and but I was posing a question to Michael, and he politely pointed out that I was completely wrong, which was hugely embarrassing to me. And that was my introduction to Michael Krebs. And we went on. We went on, and Michael was deeply involved in efforts, brought me into a couple different meetings with Senate Finance Committee staffers over a multi-year period. So, Michael, there's a big backstory here. Got to see a little piece of that you really got to see a lot of. So tell us the backstory of what's going on here.
Sure. Thanks, Pete, and thanks everybody for joining. Great to talk with everyone. You're right, Pete. There's a long history on MEPs. Nothing gets done in DC quickly. That things get get put on the table, usually started in private industry. Policy ideas percolate. They have to be debated and considered. And it takes, could take 1 year to 10 years or more for good ideas to come to fruition. Bad ideas, too, for better or worse. But the open MEPs have been kind of percolating up. I remember the first legislative proposals, or at least the legislative drafts, about 10 years ago in 2000, maybe 7 or 8, right after the Pension Protection Act. And I think the ultimate desire of folks in Congress, after they finished the Pension Protection Act in 2006, was, okay, we dealt with the defined benefit world, but lots of people moving into the DC world. That's going to continue, and that's not going to, that's not going to reverse. And so, how do we do two things? How do we reduce costs for both employers and employees, and how do we expand coverage? And when lawmakers ask those questions and thinkers ask those questions, they said to themselves, well, why couldn't we allow small employers to pool their resources and participate in a single retirement plan? And the concept seems simple enough, and it has a nice political message for politicians, right? Why not help small employers offload some of the responsibility for managing a plan to people who are professionals? There, as you can imagine, there are a lot of stakeholders in the industry, and so there were years of kind of jockeying around what the contours of a proposal would look like. How do you deal with fiduciary responsibility? How do you apportion it amongst the parties? How do you ensure that there's adequate consumer protections versus enough flexibility and cost savings to make it worth doing? And how does it kind of slot into the larger retirement system without causing kind of tectonic shifts that would be horribly disruptive and cost potentially people their plans? That jockeying went on and on and on, and probably around 2013 or 14, a consensus view began to emerge, and around open MEPs, which was reflected in a number of pieces of legislation. Some of those pieces of legislation said, let's have a plan where the employer's not responsible at all. The employer can participate, and the employer can make contributions and transmit employee contributions, but let's let the professionals be the fiduciaries and the administrators for purposes of ERISA and the code. And then there was a more limited view that said, let's let people pool, let's reduce some of the burdens like the multiple 5,500 filings, but let's leave the fiduciary structure intact. And that wrangling continued for a couple more years. And they developed a couple pieces of legislation, the most recent of which passed the Finance Committee in 2016 on a unanimous basis. It's a pretty straightforward proposal to allow open MEPs, and it had 19 members of the Senate Finance Committee sign off on it, both Republicans and Democrats, largely no objections. Everyone from the left to the right came around and adopted the view that this was good legislation. So I always wonder, well, if that's the case, and the only thing, as Robert noted, that was stifling open MEPs in the past was the Department of Labor, what the heck happened? Why didn't the department do anything in the last administration? And then what changed now? And so the last administration, I think, to Pete's point earlier, the last administration was very concerned about the potential for theft and fraud in MEPs. The idea that if you loosen the employer's relationship to the plan in any material way, then that it increases the chance that less than reputable providers will run a plan and maybe steal the money, like the Hutchins example that Pete mentioned. And that view was pretty pervasive over at DOL and still may be amongst the career staff. However, when the administration changed, the new people in power at the Department of Labor, who are political appointees, are probably still, to their credit, concerned with consumer protections, but had a more positive view of the open MEP proposal. And that's partially because the Assistant Secretary of Labor right now, a guy named Preston Rutledge, who was confirmed in January of this year and is serving in that position, labor who are predisposed to like this idea. And so we know that about a year ago, they started work on this executive order. Now, why did it take them a year to get out this couple-page document? That's unclear. I suspect that was at least in part due to the fact that they were hoping that legislation could pass, because they feel, and I think a lot of people feel, that legislation is takes a more comprehensive view, and at the end of the day may result in a better plan. But when it became clear that there were some challenges to the legislation and that it may not pass this year, it seems like the Department of Labor decided to act. Now, they have said, the politicals there have said, this isn't intended to preempt what Congress does. If Congress passes something, more power to them, but they're going to use their regulatory authority to permit open MEPs. Okay, so with that as the backstory, you think, what would a rule look like? What's an open MEP for the Department of Labor going to look like? Now, first of all, they've rebranded them, as we mentioned, as association retirement plans instead of calling them open MEPs. That's for two reasons. One, and I think the probably simplest, is because everyone rebrands this, because the word MEP is too close to multi-employer plan, the collectively bargained Taft-Hartley plans that are facing some financial challenges at the moment, and no one, for political reasons, wants this open MEP proposal to be associated with the multi-employer system issues. But I think that the second reason is that, and probably more importantly, is that the administration just finalized a reg on the healthcare side called the Association Health Plan regulation. And that essentially allows an open MEP for a health plan. Folks might remember that the president during the campaign and after the campaign had made promises to allow insurers to sell insurance across state lines with the idea of dropping costs. Well, that promise kind of morphed into an idea that had been floating around since before the Affordable Care Act to allow open MEPs for health plans. So they spent about a year in response to an executive order that looked not too dissimilar from the one that was just released, crafting a regulation that did a few things. And I think this is really our model for what the open MEP reg will look like. First, it expanded the commonality test. Robert talked about that earlier, this idea that employers have to have some nexus and commonality to participate in a single plan. Well, it expanded that and put some meat on the bones there, and basically said that you can have commonality if the employers are in the same trade, industry, line of business, or profession, regardless of where they're located, or they're in a geographically limited area, a state or a metropolitan area. And if you think about it, that's a pretty substantial narrowing of what it means to have a commonality of interest. It's similar to a position the department took with respect to state-sponsored open MEPs for people who follow that a couple of years ago. But it really kind of shrinks the commonality requirement down to being almost non-existent, though not entirely. Now, the thing they did retain in the association health plan rule was a substantial business purpose rule, which basically means that to participate in an association health plan, you have to have a business purpose other than just participating in the plan with the association running the health plan. Now, it doesn't have to be the primary purpose, but you got to have some other reason you're connected to that organization. And I think the policy justification between that substantial business purpose test is to ensure that the organization running the plan isn't kind of a fly-by-night institution that just disappears the next day, but rather has some substantial grounding and base of support outside of just running the plan. Now,
so
Michael, go ahead. Yeah.
Well, I was going to say, let me pause you for a second. So let's circle up a little bit. So the one probably key point that I forgot to mention about Michael, the reason he was at the head of the room where I was 10 years ago, was he was working in the United States Senate, and I think you were working for Senator Harkin at the time. Is that right?
I was.
And so, and fast forward, many years in the Senate. So Michael really had a very much front row seat on this conversation, and it was a conversation between the regulators and the legislators. So I think one of the key points here is this wrangling that Michael has talked about in Washington. It occurred among multiple players. This wasn't just a legislative thing. It was, how are we going to do this? Because when there's a law passed, what are the regulators going to be comfortable saying about how they're going to enforce that rule? So there's this working behind the scenes that goes on. So a couple of key points, Michael, that I would say that the biggest thing from my perspective is, all right, we had multiple employer plans that have been around for decades, 100 years, close to. And some of them have been around that long, others are newer, but for the most part, they've kind of flown under the radar and not been broadly promoted. In the 2000s, people got interested in broadly promoting them, and this notion of the open MEP sprung out of really the PEO movement and a couple other factors. But you got this notion of an open MEP. Well, that got seemingly shot down by the Department of Labor in 2012 and all the history that Robert gave you. So you had these structures. You still have this kind of existing multiple employer plan structure that's been around for a long time. And then you have these cousins of it that develop, like the open MEP, where you do the separate audit bond and 5,500. And then these other programs like group trust and aggregation arrangements, or whatever you want to call them, that are out there that are really not multiple employer plans. They're single employer plans just bundled together for utility. That's the landscape that we have today. And then along comes basically a consensus on the healthcare side that leads to the AHP rules. And so what you're saying, if I'm hearing you, Michael, is that the association healthcare model is probably the model for the association retirement plan, which is likely to add a new option to this palette of possible plan structures. Is that right?
Yes, that's right. I think it's intended to kind of slot into the existing system and liberalize some of the rules, but I'm guessing that at the Department of Labor, what they finally come up with is going to be intended to work with the existing structures and not against them.
Well, and that's so expand on that a little bit. So at the Department of Labor, you said earlier there are career people versus folks who are politically appointed. That's obviously a different group. What's the thinking inside the DOL, and how is that driving this?
Yeah, that's a really good question. So I think no organization, whether it's Pentegra, Groom, or the Department of Labor, has unanimity internally, right? There's going to be a diversity of views, and so you have folks at the Department of Labor that have been inherently skeptical of a pooled arrangement, particularly where the employers have a loose connection to each other. And getting back to the Hutchins example, it's just they're afraid of people stealing the money. And that's been a long-running problem. And where that really flared up was in the health space, where years ago, and actually not too many years ago, there were a number of cases where people started pooled health insurance plans, collected premiums, but the premiums were insufficient to cover the claims. Oftentimes sometimes those were fraudulent arrangements, and people were left without the benefits that were promised. So there's internally at the Department of Labor, there's a camp that says we need to have strong consumer protections. Let's be really mindful of the potential issues that are raised if we liberalize the open MEP rules. And then on the other side, you've got folks who say, look, we need to reduce costs. We need to make it easier for employers, and we need to accept the reality that in some cases it's beneficial for the employers to be, particularly small employers, to be able to say, I don't want to run this plan, let's let somebody else do it. And so there's that inherent tension at the Department of Labor, and you really saw that in the association health plan rule, where they tried to strike a middle ground between liberalizing the rules while also maintaining safeguards for consumers.
All right, and let's. I think there's an interesting follow-on to that when we're talking about who's allowed to be in charge of these things and the protections, that ERISA was created to offer protections. I mean, that's the entire purpose of ERISA, and it has a structure for protections. But of course, there are legislative proposals and other proposals that would offer arrangements that go a different route. So do you follow the ERISA scheme of protection? And what do I mean by kind of where I'm headed is who's allowed to be in charge of one of these things is a point of conversation here. But if you think about an ERISA plan, you have an employer who's responsible for overseeing at least one, but typically two fiduciaries, a trustee who has sole authority over plan assets under ERISA Section 403, and you've got a 316, a plan administrator as defined by 316 who has administration responsibility. You've got those two classes of chores, the investment and safekeeping of the assets on the trustee side, the administration on the administrator side. Those are the parties who run the thing. The employer is responsible for overseeing them. And that oversight piece by the employer is a safeguard. And in fact, in the Hutchison case, the person who found out what was going on was an employer. It was an employer noticing something was wrong that caught that, and that's held up as an example. But there are proposals out there, Michael, that would go a different way, right? That would basically say, you know what, we can remove the employer from the loop. You want to talk about that a little bit?
Sure. Yeah, there definitely are. There was a proposal by Senator Harkin a number of years ago that essentially said that the employer is no longer a fiduciary for participating in the plan, that they're responsible for transmitting payroll deductions, and that's it. Period. Hard stop. The idea being that perhaps employers, maybe particularly small employers, may not even be in the best position to select and monitor and run these plans. You've got a more recent bill by a bipartisan group of senators led by Tim Cotton, a very conservative Republican, and then Cory Booker, a very liberal Democrat, which does something very similar. It says for small employers, and they define that to be under 500, you've got no fiduciary responsibility, assuming the costs are reasonable for participating in a MEP. And so you still see that tension there, that desire from some to move away from an employer-based system, the way ERISA kind of is structured and really set up from an ideological perspective, to one more of a service provider-centric system where the employers are the conduit for the payroll deduction, for the money getting from point A to point B, but we professionalize the plans by giving them to the financial services industry. And there's always a bit of a tension there, because if you do take the employer out of the mix, what do you put in place to make sure that the providers are both capable and financially secure? Along those lines, if you think about it, the fiduciary guarantee, the fiduciary duties and the fiduciary liability are really only as good as the person who stands behind it. So we have seen in prior bills that some guardrails put up to ensure that the providers are financially capable. You could, for example, there was one bill that required them to be of a certain asset size, or to have a certain amount of assets under management, or to be a bank, a federally or state chartered bank, or an insurance company. You could imagine something like that working its way into the DOL proposal.
So I think where this loops is, so let's loop back to the executive order. The executive order directs the DOL to examine this issue, but the DOL has been examining this issue for a very long time, and it made some decision, or it reached some consensus along with other participants. This 10 years of wrangling that you've described in Washington, D.C., that included folks at the DOL, did result in consensus with respect to the association health plan. So how did the AHP rules deal with this question of, is the employer in charge, who's liable, and do you use the employer-based approach and ERISA's basic structure, or do you create something new?
It's a really good question. And so the way I guess I view the association health plan rule is that they tried to work within the basic structure of ERISA. They put up significant guardrails to protect folks, participants, from any potential theft or fraud. And they really tried to say, The folks that run these plans have to do something else. We talked about a little earlier that the substantial business purpose test, this idea that the organization running the MEP can't just your only relation to them can't be the providing the plan. You've got to have some other relationship. They also put a few other guardrails in place on the people running the plan that we don't have to get into here because they're very healthcare specific, but they have to do with ensuring certain non-discrimination rules are met and certain other health ACA Affordable Care Act type requirements are met. And so I think where DOL came down on that general question is that they were going to liberalize the rules, allow employers to offload some of their, but not all of their liability to a third party, still have some oversight roles with respect to the plan, but allow financial institutions and others to actually do the day-to-day management.
So is what's going on here that there's some that got achieved in Washington, it resulted in these AHP rules, is what's going on here that you have somebody familiar with MEPs who's the head of EBSA, Preston Rutledge, you have interest in moving forward on this, and now you have a model. And they say, we did it for healthcare, now let's do the same thing for retirement. Is that what's happening?
That's exactly what's happening. And they named them the same thing, Association Health Plans and Association Retirement Plans. They've got the roadmap, and actually the Association Health Plan rule is considerably more difficult because in health, healthcare is just inherently, health insurance is inherently more challenging. It's more equatable to a defined benefit plan than it is a defined contribution plan in most cases. So I think this is even an easier road. They've got a roadmap, and I wouldn't be surprised if the Association Retirement Plan rule mirrors to a significant degree the same thing they did on the health side.
So let's try to talk in high level about what this actually means. So we have again today we have closed MEPs. You have plans that already meet these definitions. Do those go away? Does this replace them?
So we have a model there in the AHP regs. They basically said let 1,000 flowers bloom. So they said if you've got an existing MEP and you like it, you can keep using it. But if you want to take advantage of the new rules, you can do that too. So it essentially said existing closed. If you port that over here, what I think they'll likely say is existing closed MEPs can continue. If you've got another arrangement like we've been calling MEP here, where it's a single plan document but separate 5,500 filings, I don't see why they wouldn't let those continue. And then you'd have a third option of an association retirement plan where there would be presumably a single 5,500 filing and a single audit.
Well, and I think people get certainly when at Pentegra, when we talk about multiple employer plans and solutions, that get a little confused. I think folks forget what they actually are. They're just a simplified form of any other retirement plan. And what causes them to be simpler is the fact that instead of 100 employers having 100 plan documents and 100 committees and fiduciaries and meetings and minutes and benchmarking, it's that part of it that gets simpler. But it's just a 401k for every other purpose, or a 403b for every other purpose. And the method that you use to get to that advantage doesn't matter to the employer. The name doesn't matter. The legal structure, they don't care about any of that. They just want to know, hey, how does this help me? So you might look at what Michael just said and say, oh, there's a closed MEP and then there's an AHP, and you know what? Not going to matter to the employer for the most part. What is a closed MEP versus an open MEP? Well, you have one 5,500, you have one audit, you have one bond. AHP would be the same thing. What would be different would just be these other rules that might get attached to it, like you have to have a specific way of setting up your governing body or something like that. So it doesn't mean you can't use the old structure. It's just setting up a different way of getting to the same benefit would be the point. And
right.
Without eliminating the other methods that you could use to get there. So,
right.
Michael, let me steer you toward governance structure. So we can have a multiple employer plan. You can have one of these other arrangements that are, that we've talked about you can have an association health plan. But let's assume, or a retirement plan. Let's assume that the association retirement plan rules do in fact track the healthcare. What does it have to look like of who sits at the top of that? Like, what's that look like? Who's the person or entity who's allowed to be in charge of one of these things?
Yeah, it's a really good question. I think a lot of remain to be seen in the regulation. We have a model both from the AHP regs, but also kind of existing closed MEPs that we look at, and there are a variety of different governance structures for those arrangements. Sometimes it's a financial institution that sits at the top. Sometimes it's an association, the American Bar Association or the auto dealers, who have a committee of what they call trustees that sit at the top and choose service providers and vet fees and things like that. As far as the association health plan rule went, they didn't give a lot of guidance on that. They basically left that open to private industry to determine what was the most beneficial. And I think that's probably what you'll see here. And it'll be worthwhile, obviously governance. I'm a lawyer, so governance is a huge issue for me. I think it's incredibly important. And there'll be a variety of structures that people can look at, and eventually the market will sort itself out, and some best practices will emerge.
Well, and I think if I could just sort of summarize, and then we'll round toward a final question for everybody here. So there was an executive order that said study this, but there's already been a lot of study going. There's already a very good idea where it's heading. There was a model achieved through some wrangling, followed by maybe grudging, maybe not grudging consensus, but consensus, difficult to achieve in Washington, that led to the association health plan rules, which follow the basic ERISA structure, exactly same governance rules, oversight, uses an old model, multiple employer plans, and allows the expansion of their use and on the healthcare side. Turning a page, hey, let's do exactly the same thing for the retirement plan side. So fundamentally what's going on is an expansion of the use of multiple employer plans on the retirement side via this perceived broadening of access to the advantage of the MEPs that is 5,500 audit bond. To a large extent, that's all we're really talking about, is granting access to that form of compliance, but making it more like the traditional old line closed MEPs, like the Federal Home Loan Bank plan that Robert described. And so a broadening of the rules, not an elimination of the other structures. And so what you're going to get, what are you going to get for that? Well, use some practical examples. So we have as a client, for example, a Chamber of Commerce. There's if you look at a Chamber of Commerce plan like Charlotte, who was at the president's press release party on Friday, can a Chamber of Commerce have a closed MEP under the rules today? We would argue no, and most people agree with us. So we have Montana Chamber of Commerce, for example, has a multiple employer plan. Well, we treat that as a closed or as an open multiple employer plan. We've got to do separate compliance. It's not a single plan for ERISA purposes. So if you have chambers of commerce who can't do it. If you are an association, well, just because you're an association doesn't mean you qualify. There's old DOL guidance that says, even some significant, well-established national associations cannot do a closed MEP under the current rules. So clearly, one of the things you get for this is a broader group of organizations that can create this. But beyond that, you have the ability to do something on a geographic basis, for example. And as long as you fit the right governance structure, as long as you have people running this thing where the clients are clearly in charge, that creates another avenue. So these are avenues that were closed that would now become open. So it's not a complete opening of the door that said anybody can do an open MEP, or in essence, an open MEP become a closed MEP. Anybody can run one of these things. Any service provider can start their own. That's not what's being done, but it appears that the direction we're heading is going from having, this structure available to broadening the access to what we would call a closed MEP today to more associations, more organizations, more regions, more cities, and things like that. I think that's the practical effect of who gets access to that. And then the other thing that I would say in kind of summarizing the what the effect of this might be is will someone want to do it? So there's the question of if you are a service provider, if you're an advisor, if you are an association or an organization who thinks that this might be a good idea for you, is the association retirement plan route actually going to be the right structure? Well, that remains to be seen. It may well be that one of the older structures is better. And as Michael said, the thousand flowers bloom. We probably have reason to expect that will be possible. So long story short, where we appear to be headed is an expansion of the ability to use the closed MEP structure within a defined capacity, but not an unlimited capacity. And so let me have us close by saying, what do you all think, Robert and Michael, what do you think the impact of this will be on the U.S. retirement system? And Robert, let me start with you.
Well, I think, Pete, it's just, it's a favorable step, and it's, as Michael and you both summarized, it's going to provide increased flexibility. So there may be, in particular, organizations that want to take advantage of those closed MEP benefits that they can't get now. And again, that's all based on the assumption, as Michael set forth, that it's not going to just let anything happen. They're going to put these safeguards or guardrails into effect. So I think that it enhances what I'm thinking of. It's going to enhance the ability to have closed MEPs, and there'll be scenarios where open MEPs will still be a better option. And I think that by virtue of this direction from this executive order, any doubts as to the viability of open MEPs will be taken away. So I think it's a step in the right direction. I don't know if it's all encompassing.
All right, Michael.
Yeah, I think I agree with Robert. Open MEPs aren't a panacea. I think sometimes they get touted as one, but they're not. They're going to be another option and another tool in the toolbox. And whether or not they are successful at the end of the day is going to depend on what those final rules look like. If the rules make the plans more expensive, to a more expensive mechanism for delivering the same benefits, potentially in a better way, then I think you will see a move in the industry towards them. If it goes the other way and they heap on a lot of guardrails that add cost but don't add a lot of consumer protections, then I don't think they'll be utilized. I think what's really positive about this is it does give another option. It allows for some experimentation in a way we didn't have before. And there are a number of existing closed MEPs that are pretty efficient and pretty effective. And so if they can do it, maybe we can do it elsewhere.
All right, and I think I want to thank my two panelists. We do have a few minutes left for questions, and I'm gonna read some of the questions online and before we wrap up for the day. So one of the questions is, are the slides going to be available online? Yes, we will post the slides online. Also, there is a white paper. So Pentegra's response to the 2012 guidance was Pentegra's stance on open MEPs. We have updated Pentegra's stance on open MEPs. So there is a white paper, part one of which is released today on Pentegra's 2018 stance on open MEPs. We'll talk in more detail about this stuff. So that stuff will be posted online. I have a question from someone in the audience here. Isn't the primary problem with a MEP that everybody has to follow the same plan document? So if, in other words, you'd have to have the same provisions, everybody have a safe harbor. That is a common belief, but it is actually not. It does not have to be that way. It can be set up that way, but certainly the MEPs we're familiar with are not set up that way. There's a great deal of flexibility. So in a multiple employer plan today, you have a plan document that has a long list of provisions. Most of those provisions, the employer doesn't care whether they're there or not. They're relatively minor details. They really care about who gets into the plan when, how much money they get contributed, when it's vested, things like that. So contributions, whether or not there are loans, whether or not you do auto enroll, safe harbor, new comparability, those are options employers care about. That flexibility is fully available on a MEP. So the MEP board or the MEP sponsor doesn't have to grant that flexibility, and some prefer to lock it down, but it is not the case that these things are necessarily very limited. There is a similar question, is it okay to have variability in the benefits? All right, so basically the same question, but a little bit different twist. So one of the ways this gets posed is, do you have a, if one group of people is allowed to get this match and this group of people is allowed to get a different match, isn't that discriminatory? It would be if that were the rule, but what the rule is that each employer must be tested separately under 413C of the code. So the compliance testing with respect to the benefits is all done on an employer-by-employer basis and is available on basically the same basis as a single employer plan. So another question that's maybe a question for another day is how will this executive order affect advisors? You know, how will this affect? Sorry, folks. How will this affect the investment advisory profession? Is this going to speed consolidation? I think we could probably offer a couple views on that, but I want to, Michael, if you would, what are your views on how this might affect consolidation in the industry overall? Will it affect it?
It has the potential. You know, it has the potential. If it's a broad, wide open, anybody can sponsor an open MEP, and employers are completely shielded from any fiduciary responsibility, then yeah, it would result in consolidation. It would put its finger on the scale of consolidation by saying MEPs have more advantages for employers than other plans. But you know, I don't think that'll be the road they go down, and I think it'll be a much more measured approach that's more consistent with the existing ERISA framework. And so, you know, I don't think you'll wind up in every single plan being employer migrating to an open MEP, though you may see some shuffling around, particularly in the small employer space, and a broader adoption of the plans generally.
So, Michael, your view is if you had a true closed MEP with all of the bells and whistles, single form 5500, single plan audit, that the guidance probably would not allow that closed MEP to open and still retain those benefits.
It may. I think that what I was getting at was, if you went and said, if the Department of Labor came out with a regulation that said employers that participate in this MEP, whatever we call it, have no fiduciary responsibility for participating, I think you'd see a migration towards open MEPs, because there would essentially be a little bit of an unlevel playing field where an employer that wants to sponsor its own plan would be liable, but if they participate in a closed MEP, they're in no way liable. However, I just don't see that being the direction that they go. Knowing the Department of Labor a little better, I don't see them ever saying the participating employers have no legal responsibility.
So I'm going to wrap up by taking a stab at that question myself, because I think this is at the heart of what a lot of the people listening are interested in today, the advisory firm. Hey, how does this affect us? How does this affect us as advisors or as service providers and so on? So, you know, we one of the comments that we heard from a peer yesterday was, could the result of this be a reshuffling of the pie, where everybody still ends up with a piece of pie, but we're going to reshuffle the pie? Well, you know, maybe not. But here's a practical observation about the effect of this on advisors. The committee level work is what is getting simplified. If your job is committee level work, obviously this has an impact, and you probably want to participate in MEPs. If you believe that they have benefit, you want to be the one who gets to help the committee. And obviously, if you're not the one who gets to help the committee, and you have a customer who joins a MEP, that hurts. Now, on the other hand, do local employers need services? Well, yes, for multiple reasons. I could go on about this at more length, but for multiple reasons, local employers want and need to see a human face. They need service, and then the employees need service. So, if as an advisor, you're more your work is more focused on helping the employer with the success of its program and helping participants and doing education and advice and working with participants, I don't see that being taken away at all in this environment. Will it be changed? Of course. So my own belief is, this has been coming, and if you check out our white paper, you'll see some reinforcement. This has been coming for a long time. And I think everybody knows it's been coming for a long time. And I think everybody knows that MEPs are poised for growth. They're certainly going to be a larger share of the marketplace. And I think service providers are not going to be out, but there is going to be some rearranging. I don't think there's any question of that. And our point is, we like having an open dialogue. We don't think we're the only game in town. We don't expect that to be the case. We'd like to see the best possible future for the retirement system and American workers evolve. We want to be part of that. I think advisors can and will be part of that. You're not going to get shut out because of multiple employer plans, but you better pay attention and figure out how you need to rearrange. And I think that's true for all of us. So with that thought, I want to thank you, Michael, so much for joining us today, especially on very short notice. And Robert, for you as well. Thank you.
Thank you. It was a pleasure.
All right. And with that, we will wrap up. Thanks, everybody, for joining us.
Thanks, everyone.
Take care.